talking about the analog to the mid 1970s in gold, and not only in gold and silver, but also in the gold mining sector. Because I think it's a fascinating topic, and I think it does actually apply. I think it's quite relevant. So can you explain to us, are we in 1975 or are we in 1976 in the gold market?
I'm not sure either of the analog applies. The similarities are, as you suggest, compelling in the sense that coming into the 1970s, we went through 20 years of prosperity, 1946 to at least 1968, 1969. Just as now we're coming off 40 years of prosperity, 1982 to 2022. Similarly, too, the prosperity didn't benefit everyone equally, and there were social divisions then as now. And there were political responses then as now. I think the greatest similarity is as follows. It was very clear, beginning in 1968, that the level of government expenditure relative to the level of government revenue was unsustainable. And there wasn't the political will to raise the aggregate tax level too much or to lower government expenditures at all. The policy response then, and I would suggest now, was and is to reduce the net present value of the obligations by reducing the purchasing power of the U.S. dollar. The U.S. government's own statistics suggest that the purchasing power of the U.S. dollar during the decade of the 70s fell by 75%. And I would be surprised if the same thing didn't happen over the next 10 years. The question you ask, which is where we are, I think isn't so much a policy response or a policy prognostication as a market response. And that's interesting. 1975, you may recall, maybe you don't, maybe you were too young, was the year in which the political response to inflation was to raise the interest rates. And in the face of that interest rate rise, many people don't know this, but gold, having advanced from $35 an ounce in 1975 to $200 an ounce at the beginning of 1975, in the face of an interest rate rise, gold fell by 50%. But gold wasn't the only casualty of a higher interest rate. The bond market fell precipitously. The equities market fell, and new home starts fell. And over the course of 1975, the political class lost their nerve. And began at the end of 1975 to capitulate in the war on inflation by cutting interest rates. And I would suggest it was that cut in interest rates, prolonged cut in interest rates at the end of 1975, that ushered in the bull market in gold, where between 1976 and 1981, the gold price went from $100 to $850. My curiosity is whether or not we have to, as a community, by we now, I'm talking about the gold investing community, whether we have to see a period of rising interest rates, and we have to see the market response to rising interest rates, particularly in the long-term treasury market and in the gold market, to see the market clearing event, which will usher in a real rip-snorting bull market. And I don't know the answer to that. I don't know if the Fed has already lost their courage. The idea that we're told at once that we have a very strong economy, but that we need interest rate cuts is an interesting dichotomy to me. And I don't know if we've already lived through the 1975 cuts or if the 1975 cuts are in front of us. I'm sorry for that long-winded answer, but it was a fairly nuanced question.
Well, what was it the 1975 cuts, or was it in 1976 that they cut?
The late 1975 into 1976.
Okay, I see. So the stock market had a brutal bear market in 1974 and early 75, and then the Fed lost its metal, I guess, and decided that it was going to cut. And the stock market had a good, year or two there in 75 and 76. But it was 75 that shook out the gold investors, right?
It was brutal. It was actually fun to watch. I was young enough that, with my relatively meager savings, I was able to stay the trade, which is to say I was able to increase my gold position during that shakeout. I had other sources of income. There were other people who were at least psychologically all in gold in the run-up that occurred earlier on. And it was, in effect, tragic to watch people who had the narrative right, who understood that gold was going to do well, confuse a long-term narrative with a short-term strategy and get shaken out of gold. I knew a reasonable number of people who, when gold declined from $200 an ounce to $100 an ounce, in other words, when it was precisely twice as attractive arithmetically, who didn't have the psychological staying power to stay the trade.
So yeah, it's fascinating to me because there's a lot of signs that we could be in 1976, that the Fed is cutting, maybe inflation is not going to go to 2% or lower than 2%. Obviously that's a question that we don't have the answer to, but there's some signs it might be sticky. And in fact, the Fed may want inflation to be sticky near 3%, because of the debt situation, that we face. And so, in the gold mining sector, maybe 2022 and 2023 was the 1975, was the shakeout. But yeah, I mean, we don't know.
I would argue with you in terms of the connection that you're making, that inflation was measured very differently then than it is now.
Uh-huh.
In the first instance, inflation then wasn't hedonistically adjusted, which is to say that the people who constructed the index didn't try and tell you how nice an apartment you were renting or what your computer was worth. They just looked at the numbers. Secondly, when inflation was figured in those days, they didn't exclude food or fuel. Given that I eat, I think excluding food and fuel is rather silly. And I would suggest to you that, and I would be interested in what the people that were listening on the call had to say, whether anybody actually believes the 2.6% number, the CPI number. If people look at what's happened to their cost of living in pick a period, 2000 to today, or 2020 to today, the idea that the deterioration in the purchasing power of the U.S. dollar, at least relative to the goods and services, the basket of goods and services that you and I acquire, has only increased by 2.6%, I think is silly. They make an enormous political issue about grocery prices. I don't think they'd be making an enormous political issue if grocery prices had increased by 2.6% compounded. I was in California 2 days ago, and I paid $6 a gallon for gasoline. The idea that over the last 4 years that the price of gasoline has increased at 2.6% per annum is silly. There's a huge hue and cry now about the price of medical insurance. if the price of medical insurance were increasing at 2.6% per year compounded, I don't think there'd be as much fuss. But the oddest thing about the CPI to me, and again, I'll leave it to your audience to consider, is the fact that the CPI doesn't include tax. When tax is the largest household expense for most Americans, greater than energy, food, or shelter combined, the idea that you don't include tax in your own calculation of inflation is silly. I think one of the things that's happened is that in the period, let's say 1980 to 2020, many people have become accustomed to paying attention to the government's definition of inflation, the CPI definition of inflation. I would suggest to you that the real rate of deterioration of the purchasing power of the U.S. dollar is closer to 7.5% compounded. If you measure inflation the way I do, relative to the way they do, the difference between 2.6 and 7.5 is a very, very, very important difference. It means, among other things, if you believe that 2.6 is the number and you're receiving 4.5 on interest, it means that your savings are maintaining their purchasing power in terms of the basket of goods and services that you consume. If, rather, you accept my number, which suggests that the deterioration of the purchasing power of the U.S. dollar is at 7.5%, if you save at 4.5 and lose purchasing power at 7.5, it means, for example, that the U.S. 10-year Treasury makes you 3% poorer every year for 10 years. It was precisely that realization in the early part of the decade of the 70s that caused massive disintermediation out of longer-dated deposit instruments into gold. And I don't think we're there yet in terms of our consciousness.
Yeah, that is a very good point. The way that CPI is measured by the economists is not actual inflation, and certainly not inflation of the currency. And, it's a snapshot in time. So when they say, oh, it's 2.6% inflation rate, well, maybe this exact second in time, just based upon the few gauges that you're analyzing, it's 2.6%. But certainly, I think we can all agree our cost of living over the last 5 years has increased by 40% or more, depending upon where you live and what you consume. So, is inflation, it's basically not avoidable at this point. That basically it's an unstated policy of the Fed now to have inflation remain sticky. And the fact they cut 50 basis points in September with what is, by most accounts, a robust economy, is a sign that they don't want inflation to drop too far, that they actually want it to stay sticky around 3 or 4%. And they actually want to help the Treasury finance itself. And having the Fed funds rate at 5.5% is not supportive of the Treasury financing itself when it's selling T-bills at such an alarming rate. I mean, is that basically the number one reason to hold gold and silver at this point in time? Is that, inflation is now an unstated policy, of the Fed?
I'm not sure it is a policy. I'm not sure that they don't realize that they no longer have control. I'm not sure that the job of the Fed, as the Fed sees it, isn't any longer simply to maintain confidence. I'm in personal contact with some lower level members of the Fed, both because I'm starting a bank called Battle Bank, which requires the Fed's assent, but also because some of them read my work and it amuses them. And I can't talk to the upper levels of the Fed, which is very political, but the lower levels of the Fed were uniformly opposed to cutting the interest rate, believing that they were the only arm of the federal government that stood between the U.S. dollar and its demise. The upper levels of the Fed, despite their professed independence, are extremely political. And I think that they looked at the non-government sector jobs reports. They looked at the plateauing of home prices in some areas. They looked in particular alarm at the decimation that was beginning to occur in the long bond market, and they lost their nerve. But let's look at some math. Let's assume that the people at the Fed are not innumerate. The on-balance sheet liabilities of the U.S. government, represented by their bond holdings or bond obligations, now are crowding $36 trillion. Now, it's important from an arithmetic point of view that from that number you deduct $6 trillion, which are the net holdings of bonds owned by the Fed. So the net debt number there is about $29 trillion rather than the 36 trillion stated. But a much more dangerous number is the net present value of off-balance sheet liabilities of the U.S. government. These aren't bonds. These are promises for entitlements that have been made that haven't been funded. Medicare, Medicaid, Social Security, federal workers' pensions, military pensions, the Environmental Trust Fund, these type of things. That number, according to the Congressional Budget Office, these aren't the nominal liabilities, by the way. This is the net present value of these liabilities, unfunded, exceeds by their estimate $100 trillion. That means that the net obligation of the U.S. government, not including state or local governments, the U.S. government to bondholders and recipients of promises, Social Security people, old folks like me, exceeds $130 trillion. The Congressional Budget Office estimates that the net private wealth of Americans right now is at $140 trillion, which is to suggest that the combination of our on-balance sheet liabilities and the net present value of our off-balance sheet liabilities consumes $130 of $140 trillion in private net worth. We are attempting to service this debt with an on-balance sheet deficit that exceeds $2 trillion a year. In other words, rather than service this $29 trillion in net debt, we are growing it by $2 trillion a year. And the estimates to the accretion of the net present value of off-balance sheet liabilities is estimated again by the U.S. government, not by some cranky old libertarian, at between $2 and $4 trillion a year. I would suggest to you that the only way to deal with this politically is to inflate away the net present value of the obligation. In other words, to say to some cranky old libertarian rickrule, we promised you $4,000 a month in Social Security, whatever the number is. We're going to give it to you. We're not going to cut your $4,000. What we're going to do is make it so that 10 years from now, that $4,000 buys $350 worth of goods and services. That's how we're going to deal with it. And in that sense, I truly do believe that past is prologue. That's how we dealt with that. That's how we dealt with the hangover of guns and butter in the 70s. And I think it's how we'll deal with the hangover of 40 years of profligacy now. In that sense, bringing it back to gold and silver, you will recall, forget the first part of the decade of the 70s, where gold ran from $35 to $100. That was probably a coiled spring effect from price-controlled gold. But I would suggest to you that the move in gold from 100 to 850 had everything to do with the decline in the purchasing power of the U.S. dollar.
Yeah, I think that's a good point you make, that the first, leg higher from 35 to 100 or so was just, allowing it to trade free again. But then 100 to 850 was due to the purchasing power lost in the currency throughout the 70s and the really high inflation towards the end of the decade. I've heard you speak many times, Rick, and one of the points that you harp on and you really pound the table on, repeatedly is how much you love hate. And as an investor, there's nothing more that gets you excited than when an asset or a sector is hated. The junior mining sector just happens to seemingly always be hated. So it's kind of perfect that's where you focus, is in this obscure corner of financial markets, the junior mining sector. It seemed like in October that this much hated sector was starting to become a little less hated for a couple of weeks, but it seems like we're right back into the hate again here at the beginning of November. Now, maybe that has to do with some election fears or what have you. But what's your sense for where the junior mining sector is at? I mean, it feels like with gold at 2750, these stocks should be doing a lot better than they are.
So let me make your audience sick, and then I'll make them well. The junior gold mining sector deserves the hate that it has enjoyed. It's important that we understand that. If you invest in the sector as a whole, you will go broke. That's what will happen to you. If you merged every junior worldwide into one company, Junior Explore Co., maybe 2,000 companies, I don't know how many there are, that company in a very good year would lose $2 billion. In a bad year, it'd lose $8 billion. I like to joke, what price-loss ratio is appropriate? Should we be happy paying 8 times losses? Or 12 times losses? Or in a bull market, how about 15 or 16 times losses? The truth is that the level of general and administrative expenditure and exploration inefficiency in junior mining is, from my point of view, unsustainable. The sector, taken as a whole, sucks, irrespective of the gold price. And speculators need to understand that if the price of something, gold, that the company doesn't have any of, but rather is looking for, goes up, it shouldn't affect the share price, particularly when the company itself is spending 50 or 60% of capital raised on general and administrative expenses, rather than on exploration, development, or production. That, however, obscures the fact that probably 5% of the listings worldwide generate such incredible wealth, such incredible performance, that they add legitimacy and even luster to the rest of the sector. The lesson there as a speculator is that you must develop a checklist for your companies to pass so that as you are looking at them, you can discard them with great rapidity and focus your love, care, and attention on the few rather than the many. Repeat, do not buy the sector. Repeat, do not buy the sector. Repeat, cherry pick the sector. The sector is lethal. Individual companies are sterling.
Okay, fair enough. I think that was very well said. More than half of these companies really probably shouldn't exist, and they don't really have a purpose aside from just burning cash year after year, right? But back to my question. The sector is hated. I think we can assert that. I was at a conference a couple weeks ago in Fort Lauderdale, and I joke that nobody was at the gold show because everybody died. They were too old to go to the gold show. The sector has a challenge with finding new investors and attracting a younger audience. Why isn't 2750 gold high enough to attract that audience?
That'll come. I have no fear. I'm, despite my advanced age, actively trying to expand my own audience for gold shares. And I'm delighted to say that my double opt-in subscriber base grows by 50 to 100 people a day. Delighted too that well over half of my audience is under the age of 50 and 35% of my audience is female. And I'm just one cranky old bald fat boy. I think that the gold mining community has failed to attract a new audience because they're simultaneously stupid and lazy. We were stupid and lazy at Sprott in 2009, 2010, 2011. We looked to access the same audience that we had accessed for 40 years. And we look to access them through the same channels, the brokers and the investment banks. And basically what happened is it was that the industry came to resemble a whole group of televangelists that were passing the collection plate through the choir. In 2011, I began to experiment with social media channels as a more efficient way of communicating with the existing gold audience without having to deal with the filters that were conventional media or the investment banks. And I found, lo and behold, when I began addressing social media, which is where the young people were, I began addressing young people. The audience around gold and silver, or rather I should say developing an audience for gold and silver around young people, is very, very, very easy. If I can do it, the industry can. It's just that the industry is too lazy. When at Sprott, we began ignoring the traditional distributors of financial products to the community, the broker-dealers, and we began to ignore conventional advertising, and we began to focus on offering up educational products around gold and silver on social media, we grew our physical trust, exchange-traded physical trust product suite, including our gold and silver trusts, from $1.5 billion at the beginning of the period to $30 billion now. They're out there. It's interesting to note. I like to get away from narrative to statistics. It's interesting to note that according to J.P. Morgan Chase, the market share enjoyed by precious metals and precious metals related investments in the United States of America is less than 0.5%, which is to say that less than 0.5% of all the savings and investment assets in the United States of America are denominated in precious metals and precious metals related securities. What's particularly worthy to note is that the 4-decade mean number is 2%. Gold does not need to supplant the U.S. dollar. Gold does not need to crater the U.S. Treasury market. All gold needs to do is revert to mean. If precious metals reverted to mean market share over the last 40 years, demand for the stuff would quadruple. And given the fact that there is, in my view, a probability that 75% of the purchasing power of the U.S. dollar denominated savings products are going to be inflated away over the next 10 years, that's precisely what I think is going to happen.
So going back to this concept of hate and being a contrarian investor, we can establish that the junior mining sector is still very hated. I think we can establish that gold is in a bull market. Silver is in a bull market. The the narrative is being established by the gold performance, the gold strength, but the juniors are still very much lagging. Is there any other time in the last 50 years that you can recall a similar setup where, like an asset class led, it was clearly in a secular bull market, but the equities lagged for an extended period of time because they were so hated, because the investing public had learned to hate them and never want to own them?
Yeah, at least twice. 1989 to 1991 and 1998 to 2002. These were both periods where you were entering into classic precious metals bull markets, where at the beginning of the period, the entire asset class was disliked. It's difficult to remember the disdain that the gold markets were held in. Really in the period 1989 to 2000, but there was real disdain. And the juniors were held in greater disdain. So yeah, I've seen this. And I would suggest to you, by the way, that the junior market is truly bifurcating. I have attempted in the last 18 months to participate in about 30 private placements. Actively attempted to participate. And by the way, from a historical viewpoint, these were very poorly structured private placements from an investor's standpoint, which is to say crudely, they didn't include enough warrant coverage, really, to make it worth your while. But in the private placements that I've attempted to participate in virtually every case, they were oversubscribed. In virtually every case, I was cut back. And in 4 or 5 of them, I wasn't allowed in the private placement at all. The industry is suggesting that it's undercapitalized. And I would suggest to you that an industry that loses $2 billion a year on a consistent basis is overcapitalized. It shouldn't have any access to capital at all. What I think you're seeing is a group of companies, and more particularly, a community of technology people and financial people that have very good access to capital. And they have access to capital even in places like Congo, Sierra Leone, the Ivory Coast, Kazakhstan, Bolivia. And then you have the rest of the market, which I would describe as the lame, the halt, and the blind. And they have access to the capital which they deserve, which is to say none. I think that this is a fairly healthy market that we're seeing now. I would love it if 1,000 small companies went to listings heaven, if they just went away. And if rather than continuing to churn through the savings of, widows attracted to it, that money was concentrated in the hands of people who have already been successful, who are doing work, it would be better for all of you. Let me share an interesting statistic with you. Some years ago, and I suspect it's worse now, we hired a young intern, and among the other assignments I gave him was to pull 25 TSX-V companies, then, frankly, VSE companies, pre-TSX-V, at random, and look at 5 years of the balance sheet and the income statements on a quarterly basis and talk to us about the meaningful trends. And I actually didn't have anything in mind. I just wanted to see how the young man thought, and to get him to understand how to pay attention to the interplay between the balance sheet and the income statement. Something, by the way, that I urge every listener on this call to do for their own education. At any rate, he asked me what I was looking for, and I said, well, if I told you, it wouldn't be an exercise. You wouldn't find it. So he did that. And in 2 weeks, he called me back and said, okay, I got it. And given that there was no get from my viewpoint, I said, okay, interesting. What is it that you think you got? And he said, well, of the 25 companies that I looked at, the median company spent over 60% of capital raised on general and administrative expense and less than 40% in the ground, which is to say, statistically, this is a real recipe for exploration failure. And those of us in the business of speculating in small stocks need to understand that if you look at the industry as a whole, if you consider junior gold exploration or junior gold development as a sector, it is bankrupt. It's bankrupt because the structural leakage of capital is too great to continue. If you buy the sector, you will become poorer until you go broke. If you segregate amongst the sector, you can do extraordinarily well. And what you'll find if you segregate hard enough is that the sector isn't underfunded. It's overfunded.
Very, very good points, Rick. I think you said it perfectly. And I was just trying to, lead you to a place where we could sort of say, maybe it's exactly as it should be, and the sector gets what it earns, right?
Let's look at the good news now. This will make me sound woke. Take some doing. The truth is that the people in the sector as explorationists are the best they've ever been.
Yeah.
You are seeing, because the sector has had some access to capital for 40 years, great explorationists coming down from the majors to work in the juniors. You are finding promoters who are proficient at accessing teams, at accessing capital, with political sophistication. I really shouldn't say this, but you're starting to see people in the sector perform who don't look like me. They aren't old, fat, bald, white guys. They have darker hues, which is great because they work in darker companies. Again, this is going to sound woke. You're finding more and more and more females running companies. It makes absolute sense that if half of the IQ in humankind has indoor plumbing, that the ascent of those people to higher levels means that the median level of performance should increase. This is all good. And underneath the literal death of the traditional constituency, the old, fat, bald, white guy, the fact that demographic who came of age in the 1970s is literally dying. There's this enormous substructure being built of young people. My database, as I say, grows between 50 and 100 people a day. It's uniformly under 50. It's uniformly very highly educated. It is more than 50% non-white. It's 35% female. The truth is that the audience out there is building extremely rapidly. But the industry is too old, too male, too white, too stupid, and too lazy to access it. That'll take care of itself. I have absolute confidence. The constituency that drove the gold market through the decade of the 1970s in the gold stocks didn't exist in 1968 or 1969 or 1970. It's a constituency that was built over 5 or 6 years. We're in the early stages of building that constituency today. And the challenge for the management teams will be to learn how to access it. I'm looking at the listeners, by the way, on my phone. And there's a whole bunch of people here who are going to be partially responsible for the creation and the organization. And I would say actually the paradigm of that new community. They're going to be the connective tissue between the market and the audience, and the management teams. And I think that's all good. When I was coming up, you sort of had your choice between, barons or barons. I guess the voices from the outside were the pioneers of what you all are doing, the Jim Dines and the Doug Caseys and the Bob Bishops of the world. But I'm frankly very, very optimistic about the development of a new constituency in mining over the next 5 years, which is younger, and substantially better educated, and by the way, substantially more culturally diverse than the generation that the industry relies on now, which is, by the way, all dying.
Yes, it's true. Yes, so I agree with you. I'm more optimistic than I've ever been, quite frankly. And I think you make a good point that we have some of the smartest people we've ever had in the junior mining sector, some people who really know how to do exploration right, who know how to harness the technology we have at our fingertips now in 2024. Just so much power, available here, in terms of AI, in terms of technology, that we can do, exploration way more efficiently and cost effectively than we were able to do 20 or 30 years ago. And there's a lot of smart young people in the sector in their 20s even, but I would say, mainly in the 30s and 40s, but, people who still have a little bit of, runway left and aren't a part of that, generation above 70 that you're speaking of, that may be, leaving us at some point soon. I love your stories, Rick. So, so I want to tee up a story here, and I also want to invite a couple people from the audience to ask you a question if they have a question. Just ask to speak, and I'll call on you as soon as, Rick is done with this next question. So we're approaching what's generally called the tax loss, selling season in the junior mining sector that usually happens the last 2 months of every year. And sometimes this time of the year can really bring about some tremendous opportunities for those who know how to take advantage of it. So I want to just sort of ask you to come up with potentially an example from your investing track record where maybe you were able to pick up a tremendous bargain, a deep value opportunity during tax loss, selling season.
They're so numerous. I mean, so numerous. The truth is that most of our market, if you define our market as the speculative juniors, is made up of investors who have bought for a long-term narrative, but employ a short-term strategy. In other words, they buy because they think the gold price is going to go up, or they buy because they think the gold price is going to go up, and they think that an exploration vehicle is going to go to PEA, BFS, construction, something that would take 5 or 6 years. But they have trauma holding stock over a long weekend. These are incongruous. I remember, as an example, the extraordinary sell-off that happened in the uranium juniors in 2021, or the silver juniors also in 2021, because the silver squeeze didn't work. The general malaise in those markets gave way to disgust mid-year, and became panic during a period during tax loss selling where there were more sellers than buyers. If you really like a company and you think it's attractive at $2, statistically you should like it twice as much at $1. Remember that the money is made on the juxtaposition between price and value. But most investors, because the price information is easy to ascertain, pay attention only to price. It's the juxtaposition of price to value that matters. The problem for most investors is they have no opinion as to value. They only follow price. And so tax loss selling shakes their conscience because they don't understand that what they're seeing is a sale in front of them. To me, I can't tell you how many times, but it must number 100, where I have been afforded excellent buys, and even more trading opportunities, in the real penny dreadfuls, in the earlier stage exploration plays, in the period between tax loss selling and the PDAC, there's often 30% up moves in stock simply as a consequence of dead cat bounces. My great friend John Kaiser, who has written the bottom fishing report for, 40 years, has cataloged, I'm going to guess, 500 times in 40 years where companies have had 30 to 40% up moves in share prices with no change in the affairs of the company, just because the predominant seller, the tax loss seller, got exhausted.
So you made an important point there that people tend to just follow price. And we see that on social media all the time where, for example, in a junior mining sector a junior mining stock chat forum, a stock might tick up 5 cents, and then all of a sudden the banter on the channel turns to optimism and positivity. Then a few days later, stock ticks down 10% or 15%. Oh no, pessimism. There must be something wrong with the drill program. We must have bad assays coming because it's trading lower. And that's the narrative. It's tick to tick, hour to hour. There's no real value there. There's no real grasp of value and long-term thinking, right? And that's the way the world has moved increasingly short-term in 2024. And I know you push against that vehemently, that you are only interested in longer-term thinking. How does an investor in November 2024, a junior mining investor or just an investor, actually have a grasp of what value is?
Well, this is very self-serving, so thank you for that question. You go to Rural Investment Media and the Rural Classroom. We have probably 100 hours of instructional videos or interviews that talk about how to ascertain value. If you don't have an opinion as to value, what's price information worth? Money is made on the delta between price and value, or price and expected value. And if you don't have any opinion as to what the value of a company is now and what the accretion of value will be as a consequence of the capital expenditures being made by the company, what use is price? I mean, all price is, in the absence of a sense of value, is a floating abstraction. But it gets worse than that, to be honest with you. It's instructive to follow the uranium trade in the last 10 years. Nobody wanted to own uranium when it was $30 a pound. Nobody. Despite the fact that the industry average cost of production, including taxes and cost of capital, was $60 a pound. What that meant was at $30 a pound, the price of uranium had to double. It had to double, or the lights would go out. Nobody wanted to own it. We were able to find enough people who wanted to own it through absolutely obnoxious and ceaseless interviews on social media. But now, with the spot price of uranium in the 70s, a lot of people want to own it. Even more wanted to own it when it was 100. It would appear that in order for the narrative to be justified, the price action has to sanction it. The problem with that is, at 70 or 80, the price of uranium doesn't have to go up. It can go up. I think it will go up, but it doesn't have to go up. At $30 a pound, the price of uranium had to go up. The idea that people ignore math for narrative, and then even having adapted the narrative, they forget to price it, is probably the reason why an old, fat, tired, bald guy like me can continue to outcompete younger, smarter people.
All right. Time for some brave people to speak up and ask a question to Rick Rule. It could be a question about investing. It could be your favorite stock. We have a question from the audience on Solid Core, the former Polymetal. Do you have an opinion on this stock, Rick?
Yeah, I don't have the courage to own it, for two reasons. Great big deposit. Great challenge, but more importantly, metallurgically challenged and permitting challenge. If it works, it's a long ball home run. I don't allow myself generally to participate in speculations where I don't know enough to be competitive. And I wouldn't describe myself as being metallurgically expert enough or expert enough with regards to local politics and permitting that I could own that stock.
Last time we spoke, we talked about the Yukon and we talked about Banyan, Snowline. I'm just wondering, you said that you were happy to see Snowline falling back in August because you wanted to buy it. Did you buy any Snowline? And, do you have any other stocks that you like in the Yukon?
Yeah, I bought a boatload. I'll continue to buy it. And I had a very, very interesting phone discussion with Banyan, which is causing me to spend some money with some consulting engineers to come to understand that deposit better. I'm positively inclined. I really, really, really like the young woman who runs that company. And although I haven't bought any stock yet, I need to say I'm positively inclined. I also like Fireweed, understanding that both Fireweed and Snowline are really constrained by their remoteness, and the fact that the front-end capital cost to build those deposits will include a lot of infrastructure. Those deposits are both, by any classification, world scale. And while I don't think that you will have construction starts in the case of either of those projects for 5 or 6 years, I think that the scale of the deposits are such that they will be must-own deposits for majors. I think they'll both be tier one deposits within my definition being a minimum of $10 billion US dollars in recoverable reserves and resources at today's commodity prices with substantial exploration upside, and deposits that will be in the best cost quartile worldwide in terms of all-in sustaining costs in their commodity, while simultaneously being in the best quartile worldwide in returns on capital employed. I think both of these deposits meet that criterion. I will confine new acquisitions in those deposits because I expect to have to hold these things for 5 or 6 years. I will confine new acquisitions to periods of time that exhibit substantial market weakness or fears that the project are subjected to that don't have much to do with the project. This recent thing in the Yukon, where you had a pad failure at Victoria, has thrown perception about the future of mining in the Yukon into substantial doubt. It's thrown permitting into substantial doubt, when the permitting activities around these two deposits will happen 5 or 6 years from now. A lot will have changed by then. Most of my competitors don't have 5 or 6 year horizons. Despite my obvious age at 71, what I've learned is that 5 or 6 years is a reasonable timeline. Not that I wouldn't prefer earlier answers, but rather because 5 or 6 years seems to be the answer that's required.
A lot of people love silver and silver juniors. Did you see the news from Dolly Varden, silver, this morning? They reported some assays, including, 35 meters of 12.2 grams per ton gold and 90 grams per ton silver. Rick?
Yeah. Nice hit. You can't take those hits in isolation because they have some very, very, very nice, Heindel faults. And so you really need to take those hits in the context of the overall deposit, which I have not done.
Uh,
I am a Dolly Varden holder. I would say, a personal friend of the CEO. I'm attracted to both the Ridge deposit and the Valley deposit, but I'm particularly attracted to the possibility, however remote, that they're part of the same mineralizing event. And so I'm particularly interested in exploration that takes place between the two deposits. I will say I bought a lot of stock there in December and January of this year when the junior silvers were really hated. And I bought it simply because I love hate. The consequence of that, and I got to disclose this, is I've now sold enough Dolly Varden that I have the rest of my position for free. If the stock were to encounter unwarranted hatred, which is to say if the stock fell by 30 or 40 or 50%, I'd replace my position. I'd buy again.
yeah, that was a really nice opportunity back there in January, February when that exchange traded fund was selling a bunch of silver stocks, including Dolly. That was a great opportunity to get in at 70 cents and even lower. A question about the Typhoon technology, and what are your thoughts on Typhoon and how it could change the exploration game to try to find the ore bodies that are deeper in the earth?
Somebody will make it work. I've watched the advent of technology in the oil and gas business. Admittedly easier to do there because so much more activity takes place. There's more failure, which means ultimately there's more data for success. Will Typhoon be the technology that changes it? I'm not smart enough to tell you. I'm delighted with the fact that BHP, that has their own technology, has begun to joint venture with Friedland companies utilizing Typhoon, which would suggest that even though BHP is a proponent of the leading alternative technology, that they're attracted to Typhoon. Will that ultimately matter? I don't know. Will Typhoon matter? I don't know. I need to emphasize that despite being born in Silicon Valley, I'm not particularly conversant or expert in technology. And I would urge people on the listeners on the call to take anything that I had to say with regards to technology with at least a grain of salt, because literally I don't know what I'm talking about, nor do I suspect most other people.
Yeah, the Typhoon technology is pretty specialized knowledge. Question from RM in the audience. Go ahead and ask your question to Rick. Your speaker is activated.
Hello, Rick Rule. It's great speaking with you. I have a question about the Canadian oil industry and what's your thoughts on it going into the next election?
As an investor, not a speculator, the Canadian oil industry is one of the best places in the world to be. Great geology in the Western Sedimentary Basin, still relatively undrilled compared to the Permian Basin. World-class technology, world-class assemblages of people, and cheap. Particularly Canadian natural gas, which is hated, has outstanding arithmetics. The price of a million BTU of gas at AECO is right now about $1.50 Canadian per million BTU. That same gas landed in Rotterdam or Shanghai or Tokyo sells for $10 Canadian a million BTU, and it takes $2.50 to get it there, including liquefaction. Your prime minister somehow doesn't understand the arithmetic associated with the business opportunity of moving $4 per million BTU gas and selling it for 10. If the Canadian electorate were to thank and excuse their prime minister, I suspect a basket of natural gas stocks would be a 2-year double. A 2-week double. But my suspicion is that the length and breadth of the investment quality Canadian oil and gas industry represents as good an investment opportunity as exists in the world over the 5-year time frame. I'm heavily invested in them. I'm much less involved in the speculation around oil and gas exploration in Canada because I see better opportunities as a speculator in other parts of the world. But as an investor, particularly an income-oriented investor, it's very difficult to beat the performance that one will experience from a well-selected basket of Canadian oil and gas names. By the way, I need to step off. I have another call that takes place right now. So
Okay.
I need to excuse
Thanks, Rick. Thank you so much for your time. Thanks to the
Thank you.
audience.
Thank you,
This
Rob.
will be on Goldfinger Capital on YouTube shortly. Cheers.
I also should mention in closing that anybody who cares what I have to say about natural resources can personalize it. Go to my website, ruleinvestmentmedia.com, list your natural resource stocks, and I personally will rank them 1 to 10. No obligation, no charge.